Hello, ladies and gentlemen. My name is Chris Leyland and I'm the investment director who heads up the True Potential portfolio proposition. I'm here today to review 2018 and look out towards 2019, and that's for both the portfolios and markets. So before we start, let's restate what our long-term objective for the True Potential portfolio proposition is. So overall, the goal of the True Potential portfolios is to maximize return for a lower level of risk in a lower cost, highly diversified investment product. So let's start by talking through what has happened recently. Overall, 2018 was a very challenging year, and the figures on the screen illustrate how it has compared to previous years. If we then look at 2018 on its own, the slide illustrates the performance of each asset class separately. So what happened? So up until October, the US equity market had clocked up a new record, the longest lived bull market where share prices are rising in history. As we move forward, despite delivering 3 outstanding quarters of corporate earnings growth, the US market began to falter with more aggressive rhetoric coming from the Federal Reserve and nervousness from the continuing US-Sino trade war, triggering a global equity market sell-off. Starting with the Federal Reserve, it may seem a little bit odd that a group of some of the most respected central bankers discussing how well the US economy is doing and why interest rates need to keep on rising steadily wouldn't support equity markets. With the discount rate, i.e. the risk-free rate of return, rising, it meant that companies with high price to earnings ratios struggled to maintain their valuations, and therefore these were the stocks that sold off first. With trade tensions and the ever-growing doubt that US tech giants such as Apple and Amazon could struggle to live up to their newly acquired trillion-dollar valuations, the news brought major indices in the US down with a bump, with US equities one of the worst performers during the last 3 months of 2018, although that is on the back of stellar returns for 2017. So the UK did not fare very well, with political risk continuing to dominate the UK investment horizon all year. Deal or no deal varied on an almost daily basis, but that's very much specific to UK markets, not really moving markets globally. Within bond markets, you're seeing a dichotomy of returns. Higher quality government papers such as UK gilts have performed well as investors looked to more perceived safe areas to invest. On the flip side to this, high yield bonds struggled as investors rotated into lower risk paper, and a number of high-profile corporate mishaps made market participants a little bit nervous. Alternative assets came to the fore, with investors looking outside their traditional areas of equities and bonds to try and find returns that were uncorrelated to stock markets. Gold fared particularly well as investors looked to de-risk their positions. So let's move on to the True Potential portfolios and let's have a look at the actual performance figures. I think it's never comfortable to say one has performed well when client values have been pared back, but if we compare the annual performance to a reference point, let's say the FTSE 100, which is down nearly 8%, you can see that diversification within the True Potential portfolio proposition has helped clients not to experience such a large fall. Moving on, here we can see a graph of the True Potential balanced portfolio over 2018, again compared to the FTSE 100, and it illustrates lower volatility and higher returns. As for advanced diversification, this has generally worked. Within the portfolios, we have assets that actually provide a positive return in the more negative months such as December, illustrating diversification working. Assets such as gold, various hedge funds and currency funds all provided more than a positive 4% return over the month of December. Remember, the portfolios contain assets that can actually make money in falling equity markets. If we look at the managers over the year, as you know, we've added in the True Potential Growth Aligned fund range to the portfolios, which is actually one of the best performing fund ranges since it launched in May. And again, that offers increasing levels of style diversification. Looking at our other partners, Close Brothers showed their stock picking skills, producing a strong set of numbers, and they're also the manager with the heaviest weighting within the portfolios that we've added to in 2018. So this illustrates the True Potential portfolio investment process working. On the more negative side, the True Potential Goldman Sachs Balanced Fund struggled, but remember, it has a conviction position towards emerging markets, and that detracted from performance against the backdrop of US interest rate rises. The True Potential Allianz fund range also detracted from performance with, I guess it's more momentum style struggling, particularly during the down months of February and March and December. Let's move on and let's talk a little bit about the portfolios and how we manage them in respect of Brexit. Look, Brexit's a challenge for all concerned and the overall outcome is unknown, and it's sufficiently opaque that it would be unwise to try and place a trade around Brexit. What can be looked at is the facts. After the initial referendum, sterling devalued significantly, and whenever a Brexit deal looks less likely, we've seen sterling fallen. Any positive or negative news plays mainly through the currency markets. For the True Potential portfolios, our 9 managers all have different ways of tackling currency risk, using hedging at different levels or currency overlays to help mitigate overall currency risk. The beauty of the portfolios with their style diversification is that we're positioned for arguably either a soft or a hard Brexit. As the Brexit situation becomes clearer, we have the ability to add to the manager styles that we feel will be most beneficial. Outside of currency, and this is really important, diversification is paramount, particularly within an uncertain political environment. Being invested worldwide, not just in the UK and Europe, and also being invested in a myriad of assets, all designed to be lowly correlated to each other, thus offers solutions for every type of Brexit scenario. Next, a question I'm being asked is, should I move to cash? I want to be very clear on this. The way to make good long-term returns within investment is to stay invested, to compound up growth. It's not always going to be comfortable, but by letting emotion come first, you run the risk of selling at the worst possible time, crystallizing negative performance, and not being able to make that performance up. Over the longer term, equity markets have always trended upwards. And I think secondly, in an era of low interest rates, the only real way to make a decent return is to embrace risk and be invested. The days of cash in the bank offering rates of 5% are long gone, and the likelihood of interest rates climbing back up to historical levels is remote. With inflation at over 2%, cash returns significantly lower than that. Inflation is eroding away returns for cash investors. So finally for me, what's the outlook from 2019? Overall, we're constructive on stock markets as we move through the year. After 2018's falls, valuation levels are now below long-term averages. That's for all main geographies. As a consensus, the managers that we partner with still see good fundamentals, strong business confidence, and generally accommodative monetary policy. Global growth is slowing, but from the exceptional and arguably unsustainable levels seen in 2017, markets are becoming much less sentiment-driven and are now moving back to fundamentals. Federal Reserve policy, the key driver of return for virtually all of last year, Fed is now looking to pause raising rates in March, and that will allow stock markets room to breathe. The Fed is taking a more data-driven approach rather than looking at policy implementation at all costs, and this is a cause for comfort for markets. At an asset class level, overall, we see convergence with other areas catching up with the US. The emerging markets look particularly attractive, one of the best performing equity markets in Q4, with investors seeing the value that is clearly on offer for companies, many of which have been long household names in the West. Potentially weakening US dollar and better US-China relations all add to that investment case. The UK is clearly undervalued right now, and Brexit looks to be coming to some sort of conclusion. UK equities could offer good returns in 2019 and are very much an unloved asset class. Europe and Japan are both pricing good valuations. Japanese structural reform, Shinzo Abe's tenure, and a more shareholder-friendly attitude all bode well. Europe's starting to deal with last year's issues with a budget agreed in Italy, although clearly idiosyncratic risks still exist. Overall, a positive view, cognizant of risk, and one of opportunity as asset prices have fallen. Finally, it is important to emphasize that diversification is the key way to navigate through differing market events, spreading risk, not just concentrating on one single geography, asset class, and with the True Potential portfolios, we can offer a new higher level of diversification by fund manager style. Thank you very much. I'd like to take this opportunity to wish you a happy and prosperous year for 2019, and I will see you soon. Thank you very much.